way we are situated today, I would hold zero equities.
What are you saying? Sell all your stocks.
I have done that.
When did you do this?
In the second week of January.
Why? What happened in the second week of January?
Donald Trump made this threat. He said that if the BRIC nations come up with their own currency, I'm going to put 100% tariff on them. He's not going to let the dollar just fall apart as everybody is hoping and thinking, which is why it's going to get stronger.
No, but what makes you so sure that Donald Trump will win? US tech stock, which can also boom. Why don't you do that?
US tech stocks, it's a bubble at this point. Everybody, including OpenAI, is essentially betting on almost 300-400 billion that is committed. So the business model is not clear. No ROI on it right now. Very similar to the IT bubble. The poorest performing sector of the last 12 months is actually real estate and IT. Okay, I believe that India would do well.
Last 1 year, everybody has been afraid only. US AI bubble crash, Indian market is slowing down, tariff war. So what do I do? If I'm afraid, I just sit on FDs. You are somebody who has 30 years of experience, right? You have been investing in the market from the year 1995, 1996. I was born that time. You've seen almost every, all kinds of market cycles. You've seen probably 3 major market corrections. Now, as we speak right now in February 2026, the world is all over the place. People really have no clue where to put their money. We are seeing things which were never before seen, at least in my lifetime. So as somebody who has 30 years of experience, who's been there, done that multiple times over, what is the asset allocation that I should be having today as we speak? How much percent will be in the stocks? How much percentage will be in FD? How much percent should be in gold, silver, real estate, anything? Can you just tell me that? Let's start with that.
Yeah, that's a very, very interesting question. We've had a very powerful run in even gold and silver recently. If I was a global investor, I would probably say that this is not the right time to be in gold and silver as well. But with one caveat, especially for Indians. In India, even if gold and silver prices go down, they actually hold up much better. The reason for this is that gold and silver prices are inversely correlated to the currency. So when they go down in dollar terms, they're going down because the dollar is getting stronger. But when the dollar gets stronger, the USD INR starts going up, which means the rupee starts to get weak. And therefore, for Indian investors, in rupee terms, gold actually goes up a little bit, even though it goes down a little bit in dollar terms. And net, we don't lose so much. So therefore, gold investors in India have been a happy lot. And it's fair to say that you should have some asset allocation towards gold long term, especially in difficult times. However, I would say don't be overboard right now, because there could be and if you're looking at putting in fresh money, probably wait for a decent correction to happen in prices before you do that. If you're holding, for much lower levels, that may be fine, because your drawdown will be less than it will be in dollar terms. But for Indian investors, probably you can do the timing better. This may be not the apt time to get into gold and silver, because you've had such a fantastic run in the precious metals over the last year or two that it's time to step back. I would not have said this in December, but what we've actually seen in January is a hyperbolic move in the precious metal space, which has put them into sort of peak territory compared to all historical peaks that have happened in the precious metals before. So for Indians, I still say there should be an allocation. Globally, I would have said probably cut down significantly. So maybe a 10, 15, 20% max allocation to gold. Equities is a place...
Wait, even right now, as gold stands at 1.6 lakhs per 10 gram, you're saying keep 20% of your wealth in gold.
Yeah. But don't allocate fresh. I'm saying hold on to what you have.
Don't allocate fresh.
Don't allocate fresh. If your allocation is very high, say for example, you've been smart enough and you have a 50% exposure to gold, then I would say cut back.
Okay.
Cut back a little bit, because there may be some drawdown. But if you've bought at very low prices, like say if you bought 50% lower, then maybe a 20-30% drop in prices doesn't bother you too much, then it's fine. I would be much more wary of equities. So I would want to really pare down equities. However, I find, different investors with different mindsets. I personally pare down even to zero when it's required. So in this situation, the way we are situated today, I would hold zero equities.
What are you saying?
Yeah.
Sell all your stocks.
Yeah. Sell all your stocks. But
you have done that right now.
I have done that. I have completely moved out of equities.
When did you do this?
in the second week of January.
Why? What happened in the second week of January?
So the situation was that people were betting against the dollar to a record amount, because if you look at the CFTC futures data, the non-commercial traders had one of the largest short bets on the dollar during the month of January. And simultaneously, investors are betting away on gold and silver being the saving grace in a bearish dollar environment. Now, these bets went on to record levels. However, we have to also understand that United States is not going to, shut down tomorrow morning. And if their greatest strength is the dollar system, which they have, been using to trade, transact, and, keep control on the world, then this dollar-based system is not going to go away anytime soon, and they're not going to let it. That's more important. So if you see the trade deal, let's just look at India's trade deal. It's been about India not purchasing Russian oil. India was purchasing Russian oil on a transaction that was done in rupees. It was not done in dollars. That's the big issue. It's not just about the purchase of Russian oil, because if you go back a couple of years, India was actually told to buy some Russian oil when the war started, to some extent, to support oil. So why were we under so much pressure? It's because we transacted in another currency than the dollar. You've heard about the petrodollar. It was essentially a deal that the US did to protect, the Middle East.
Yeah.
So that, and for that, they said you need to price all your oil in dollars. That is how you made the dollar strong.
Yes.
Now, if the world goes around transacting in other currencies, so even Donald Trump made this threat a year back. He said that if the BRIC nations come up with their own currency, I'm going to put 100% tariff on them. So coming back to the main point, he's not going to give it up without a fight. He's not going to let the dollar just fall apart as everybody's hoping and thinking, and which is why it's going to get stronger. So look for signals of it getting stronger. And moment you see that, which started to happen only just this Friday.
No, but what makes you so sure that Donald Trump will win in this war of protecting the dollar? Because
I'm just saying he'll put up a fight.
No, he might put up a fight, but you're very sure that he will not lose. Because see, finally, for you to take a decision to sell everything in India, all your stocks, you need to pick one side. Either you pick the side of the BRICS being successful and making the dollar weaker, or you're like, no, Donald Trump, he's going to use his military power and, get some, shady shit done. So you already chosen the side of Donald Trump. So there might be some reason why you're backing him more than the Indian government.
Well, you have to see what he's doing over the last 9 months. I think he's done some of the most impossible things. Nobody would have imagined. I of course, know someone who thought he would go into Venezuela. But mostly, nobody would have imagined that he would do this overnight, or that he would be talking about walking into Greenland. So he is taking very, very strong measures to ensure that he gets the results that he wants. So I think we should not take that lightly. That doesn't mean that we're going to get into war. That may be an extreme scenario. But everything else possible to save the dollar from falling apart is something that we should be prepared for.
But I'm still not able to understand why will the actual individual companies, think companies like ITC, Reliance, what's going to happen to them that's going to make them underperform, which is going to make the market underperform.
And I'll answer this at a macro context. India was seeing extremely high rates of growth as far as earnings are concerned. So earnings growth of the Nifty 50 was running at 24-25%, small caps, mid caps running at 35-40% 3 years ago. Over this period, slowly these growth rates came down from 25% for the Nifty 50 to 15 to 10 and to 8. So we came back to single digits. When we look at GDP growth, it continues to remain at 7.5%. This year, the number is projected at 7.5% by most economists after the GST rate cuts and government spending plans that happened during the current year. So year-end number will be 7.5. So why is earnings growth still at 8%? The answer is nominal GDP growth. Nominal GDP growth is the difference between real and plus inflation, right? So when you go to this year's nominal GDP growth will be like single digits, 9%. We've probably never seen that in 30 years of data or 20 years of data, 25 years of data. It's just
usually it's a double digit.
It's usually been double digits. We used to be 15%, 17% in the 90s, 2000s.
This is because the inflation is only 1 to 2%.
Yes.
But why is the inflation so low?
I think Trump has played a very big role in this because he ensured from day one that oil prices stop rising. So even in a falling dollar environment, you have seen gold go up, silver go up, but you haven't seen oil go up. This is the most unusual commodity cycle in which a falling dollar was not accompanied by rising oil prices. You see it in 2000 to 2010, but it didn't happen this time. Because he made sure that, his statement, pump, baby pump, he kept saying that essentially meant he got all his oil companies to pump. He then got Saudi Arabia to increase production. Okay, and all these increased, and now he's got Venezuela on. Okay, so they also, over time, will probably bring production back on the market. All of this to ensure that oil prices don't go up, because that is the biggest component of inflation. And in an environment where earnings growth is not picking up because of the nominal GDP problem, which I've actually highlighted, okay, which means that how do you say that current market valuations are fair?
And the reason why the nominal GDP is in single digit is because oil prices have not gone up, because of which because inflation is low, because of oil prices not going up.
Yes.
So in a way, oil price not going up is creating underperformance in stock market returns.
Yes.
Really? That's how it works.
That's how it actually works.
So you need oil prices to go up for Indian stock markets to perform well.
John Maynard Keynes, he called it the invisible hand, right? Inflation.
Okay.
But that's not what we are told by the popular press. We have said falling oil prices means stock market should go up. If you plot a chart of oil prices and the stock market, you will be surprised at how highly correlated the two are. The bad news is not that oil prices go up. The bad news is when oil prices go up too fast. So if they rise suddenly 20-30%, that's called the oil shock, like we had in the 1970s once, and we had it once again in 2009. Very sharp moves, oil shock, because immediately it spikes inflation and you have to raise interest rates. But if you see oil prices going up slowly, it creates mild inflation, which is actually what we call as good inflation, which is why central banks don't have a 0% targeted inflation rate. US has a 2% target, India has a 4% target, because we need that much for stable growth to actually happen.
Interesting. That's what moves the market. So now that is not happening. So the market is affected, and you're losing hope in the earnings growth continuing to increase in the next 6 to 9 months, due to which you've sold all your stocks.
Yes.
So if you've sold all your stocks, so where is your money now? 20% is in commodities.
Yes. In gold, gold would be an option in India. Okay.
Where's the remaining 80% of your money then?
It will have to go into bonds. I don't see any other option right now. I would have said, like gold, another hard asset is real estate. It's not an asset class that I'm very familiar with, but one thing that we can actually see is that real estate at the margin is showing weakness, at least from a stock market point of view. We are seeing the poorest performing sector of the last 12 months is actually real estate and IT. So these are two sectors that I would actually be wary of and be a little away from. So I'm not so sure whether this is the right time to be, betting money on real estate.
But you also now have the option, if you're saying the US dollar will strengthen.
Yeah.
Why don't you?
Why not move the money out there and buy a US bond fund? Yeah.
Or even a US tech stock, which can also boom. Why don't you do that?
US tech stocks, there's too much being said about US tech stocks. I've been trying to figure out, is this whole AI thing a bubble or not? Couple of people I speak to, I wouldn't say I'm an expert on the AI theory, but who I speak to there are saying that it could be, because all the spending that the US companies are doing, almost 300-400 billion that is committed, has no ROI on it right now. Everything is betting on the.
Who are you talking to, if I may ask? Who are subject matter experts in this?
Well, my brother, who's in the tech sector, working in semiconductors, and he's a senior VP with one of the semiconductor companies, Taiwanese companies.
Okay.
So his insights are that all the investing is not positive ROI right now. Everybody, including OpenAI, is essentially betting on that something will work out, and some of the products will make money. It's very similar to what ended up happening in the IT bubble, that you set up so many websites, you ended up hacking all the domain names, and then only a few of them finally made it. So the business model is not clear. What is going to really work and get you cash flow at the end of the day. A lot of spending is happening because somebody wants to hit that business model first. And for that reason, a lot of money is getting spent, and that is creating GDP growth, and therefore it all looks rosy. But it's not an ROI project as of now. And that is the reason people think that it's a bubble at this point.
No, but you're anyway looking at it from a short-term investment horizon, right? You're not looking at buy and forget. So from a long-term investment horizon, looking at from a technicals point of view, wouldn't it still make sense for you to ride the momentum of these US tech stocks?
Tried and tested. So I've tried in the last 12 months, I've actually stayed away from going back to the US. I can say it's a maybe bad idea because I actually thought, I believed that India would do well.
Okay.
My change in views only happened, like you said, like I told you, 15th of January. Right? So till that point of time, I actually thought that things would have turned out better, faster. Because this was a time when the dollar was falling and emerging markets were doing well. Taiwan, Korea, Brazil, all these markets are up 60 to 80% in the last 12 months. India is not. India has missed out on an emerging market rally that I thought would get triggered by a trade deal much earlier than it actually happened. Okay, so I was anticipating it would happen from, July onwards when they said, it's not happening when things got bad. Post-September, when markets started to pick up, I thought something would have happened by December, Jan. And it did not. So we sort of missed that boat. You see, so my asset allocation happens based on the triggers that I see on the dollar, bond, and all these macro factors. Now, when these factors started to change, I'm like, fine. Now, if we are even done a deal, we already missed the emerging market rally. So now I am betting on the idea that
what
India will catch up.
The emerging market rally was triggered by the weakening dollar.
That's a major factor.
But India couldn't ride that wave because the trade deal wasn't done.
Yes.
But with the other emerging market countries, the trade deal was done.
Yes.
India was the only one left out.
Yes.
Because of which India missed this rally.
Yes.
It could have been what kind of a potential rally, according to you?
You would have gone to 28, 30,000 even, 29, 30,000 Nifty. It was a possibility.
So you're saying we missed it?
We missed it.
And you had all your money in India that time?
I had all my money on India.
You didn't bet on Taiwan and these Brazil and all of those companies. If I had to go deeper into the asset allocation then, so you're saying 20% is commodities and 80% is bonds. Commodities, what are you doing in commodities? Gold, silver, any other metals that you're looking at?
No, now I'm out of gold and silver.
You're fully out?
Yeah, from an investment standpoint. None of the physical.
But did you ride the wave of gold and silver?
Yeah.
No, but how are you making these decisions? Because they are commodities at the end of the day. How do you know what is the true value of gold and true value of silver for you to take a call on exiting it?
It comes back to the dollar. And it comes back also to a study. So, of course, I am someone who looks at charts and price action. And we apply what is known as Elliott wave analysis. And Elliott wave analysis finds its basis. So, it gives structure to what is known as the Dow theory. See, Dow theory, what it said is that if prices move up, they move up in stages. Like you have a first stage, a second stage. At the third stage, you actually go up above the peak that you made in the first stage. So, when you make a higher high, we say that the trend is up. In Elliott wave analysis, we say the first stage is wave 1. When you pull back and make a higher bottom, it is wave 2. And then when you surpass the previous high and go strongly above it, then it is wave 3. And the fourth wave then never falls below the high of wave 1. So these are the basic rules of Elliott wave analysis. And the third wave is never the shortest and so on. Now, when we apply these, and why do they work? So one is applying them, and why does it work? This finds its roots in studying mass psychology. Now, we know markets are what? Markets are a herding instinct. So people who don't believe in something slowly start believing that, yes, there may be an investment case here. You initially get what is known as value buying. That is the first wave of the market moving up from a bottom. Let's say it's a COVID bottom. The first wave is value buying. Value investors step in and say, this is too cheap, let's buy. Okay.
Yeah.
Then there's a pullback. Okay. This pullback is because the fundamentals have still not changed. And so you get a value pullback, and it often feels that things are still pretty bad, but valuations are still good. Then eventually things start improving. Earnings growth starts to show up. That is the third wave. Third wave is where you actually see improvement and everybody recognizes that improvement. Okay. And then that goes on for such a long time that prices move too far, and then you get an unexpected correction, which is called the fourth wave. And finally, the fifth wave is the euphoria last stage. But in the fifth wave, sometimes you get certain divergences. For example, growth may be slower in the fifth wave compared to the third wave. Okay. Now, this is the psychology of the entire structure. And once you complete that fifth wave, then you get a correction to it. And then the whole cycle repeats all over again.
How long does the cycle take typically?
So these cycles we study in various time horizons, but the type that I explained can last for 5 to 8 years. And you can even study this on a 50 to 70 year basis. They can be higher level cycles.
So where are we on the 5 to 8 year cycle right now? Which wave?
So I thought that we were in the fifth wave since last year. And I thought that wave, like I said earlier, would go to 35,000. I actually had those targets in mind. But in fifth wave, sometimes, very rarely, we get a truncation. So what I'm scared of right now is that it truncated. Truncated meaning it didn't go that far, and possibly we ended it early. Okay, I could be wrong. Some of my own subscribers are saying, what if your original thesis turns out to be right, the trade deal is done, etc. I'm like, sure, we can revisit this by March. Okay, if we don't see the dollar and the bond markets, etc., move the way that I'm thinking, and we don't see an unwind in US equities the way I'm thinking, we can revisit this idea.
What does that mean, unwinding in US equity like you're thinking?
Which means what we discussed around the AI bubble and, the valuation.
Looking for a correction in the US market.
In the US markets as well, because what is going to happen when I say that the dollar is going to get strong and bond yields are rising, what that would cause is it will cause a global risk-off. A global risk-off is when equities fall, the dollar goes up, and then you start cutting interest rates. Okay.
Equities fall, dollar goes up.
Yeah.
And you start cutting.
And because of that, because of the weakness caused by that, you will start cutting interest rates more aggressively.
Okay.
So then you get a bond rally as well. So you get dollar up, bonds up, equities down.
Okay.
Okay. And that's an environment. It may not be tomorrow morning. It's probably 3 or 6 months down the line. Okay. But it will start showing up in the data before it actually happens. So we'll be watching that very, very closely. A lot of people also watch something known as the yield curve for being able to predict US recession. So whenever there's an inverted yield curve, they say, well, 6 to 8 months down the line, you will get a recession. Now, the yield curve was inverted for the last 1.5 years, and it started to steepen again. Now, when it starts to steepen, now for people who don't know what is a yield curve and it's going above the head, the yield curve is essentially the difference between a 10-year and a 2-year bond. Okay, so when we study the US and we look at a 10-year and a 2-year bond yield, typically what we know about bond yields is long-term bonds should yield more and short-term bonds should yield less. That is common theory and everybody understands that. But it's not always true. And then it's interesting to understand why it's not true. Many times in the past in the US, we've seen these cycles. Every 8 years, 10 years or 15 years, the yield curve inverts. When we say it inverts, it means that short-term bond yields become greater than long-term bond yields. Why that happens is people see so much money being made in stocks that they keep selling their bonds in all time frames. So they even start selling their short-term bonds and more than the long-term bonds and move their money into equity. So it causes over speculation. So an inverted yield curve essentially shows you that you've reached a point of over speculation, but that doesn't mean the recession happens tomorrow, right? Bull market can keep going on.
When you keep selling bonds,
yeah.
Oh, when you're selling your long-term bonds,
yeah,
too much,
yeah,
because you're like, I want to put it in the equity.
Yeah,
that time they
are also going down, and you're selling even short-term bonds. So therefore, the short-term bond yields become greater than long-term bond yields because the short-term bonds fell.
No, but when you sell a long-term bond right now quickly, you will have to sell them at a loss. So that basically you're selling it at a value lower than the value of the bond because you're trying to sell it faster.
That's true.
But the bond coupon rate is still the same. So shouldn't the effective yield be higher?
No. So that's not how the asset allocators think. See, I'm talking from an asset allocator perspective. Like your first question was how much do I put in equity in bond? The US markets are very mature in this. The guys there are only sitting and deciding how much to put in which ETF. He says equities are doing well. Let's reduce my allocation to bonds and buy more stocks. Okay. He doesn't look at that I'm making a loss in the bond or making a profit. He says, okay, let's just reduce.
No, but how does that inversion happen is my question. Like, how is the short-term bond yield becoming more than a long-term bond yield?
So a lot of people who own money in short-term bonds, they also start getting out. Okay. Who owns short-term bonds is people who are essentially keeping liquid money. They say, yaar, jaldi paisa idhar ban raha hai. Let's quickly move into these short-term bonds where I'm making quick money.
So people are selling both short-term bonds and long-term bonds.
Yeah.
So how is the inversion happening? I don't understand.
They're selling more of the short-term bonds than the long-term bonds.
Okay.
Yeah.
You're selling more of short-term bonds than the long-term bonds.
Yes.
And if you sell more of short-term bonds, then the effective yield goes up of the short-term
of the short-term bonds.
Because you're selling it at a discount.
Yes.
That's the logic.
Yes.
Right? Okay. So this is happening. It means there's more euphoria in the market.
This was happening a year ago.
Which means there was more euphoria.
Yeah.
Which typically would signal that there should be a correction. The correction has not happened yet.
Yeah. It happens with a lag. So it doesn't happen immediately. So economic theory is yield curve inversion predicts a recession 6 to 12 months down the line.
How many months has it been?
It's been more than 12 months now. So what we watch for, therefore, additionally what we watch for is not just the inversion. We watch for when it will start to steepen. Steepen means When the 2-year yield starts again going down, becoming less than the long-term yield. Okay.
Then sure short recession.
No, not sure short at the crossover point.
Then
a little above that. I am approximating near around 0.7. We are at 0.7 right now.
What is 0.7? Like it is already above.
Yeah, it's already above. It's become positive 0.7 from a negative.
How much more difference is left for the recession to happen? Usually,
we are at the cross point. I mean, it's just above 0.7. So it's not like, okay, if you cross 0.7, will there be a recession? But when you cross 0.7, we look for whether the markets are reacting to the potential of a recession, which means that when we cross 0.7 and we are just crossing that right now, do a US equity sell off from here or not?
Do the US
equities sell off from here?
Whether the smart money is looking at this and acting on it.
Yes.
Because only when they act on it, it should happen. But they've not done it yet.
Yes, they have not done it yet.
Do you think Trump would let that happen?
I don't know.
But you're saying
I'll tell you, okay, I'll answer on the Trump question.
Huh.
The Trump needs money in the bond market. And if he needs money in the bond market, he might have to ask equities to move to bonds again. And
why does he need money in the bond market?
Because
to service
they have
the debt.
A very large amount of bonds rolling over.
So to service the old debt.
Yes. The old bonds have to roll over, and so you have to refinance them.
So he
will not want to refinance them at these high rates. And that's why he's fighting for yields to come down.
Oh, he wants to refinance them at a lower rate.
Yes.
Got it. Okay.
So many dots to connect.
Yeah, so many dots. It is macroeconomics, right? So, I need to gather my thoughts 1 second. So, whatever you just told me, this is a cycle which has been happening many times over.
Over centuries, yeah.
Over centuries. So, in the last 100 years, how many times has this happened where the yield curve inversion happened and then the recovery happened and then there was a recession? Okay. How much percent of the times when this happened, recession happened?
So, economists claim that it's 100% strike rate. In my study, there are at least 2 occasions. So, this has happened since the 1970s, I think at least 4 to 5 times.
In the 70s?
Yeah, from 70s to today.
Happened 4 to 5 times?
Yeah.
So, very less frequency of occurrence.
Yeah.
But whenever it happens,
yeah,
recession happens.
Yeah. Once in a decade, we've seen it happen. At least once in a decade.
Okay.
Minimum.
But before 1970?
Yeah, so
there have been more instances.
Non-available of data.
Okay. But
easy data is after the 70s. So we saw it once in the 70s. We saw it once in 92, 94. You had a recession, but not a big stock market crash. So that is the one occasion where the inversion happened, but the fall was short and then it recovered. COVID also was another one.
I want to go zoom out a little bit. You mentioned one is a 5 to 7 year cycle.
Yes.
And then there is also a 50-year cycle.
50 to 100 year.
50 to 100 year cycle.
100 years, yeah.
Now I'm asking this question from the perspective of my whole life.
Yes.
Right? I have probably another 78 years to live. In what phase of the cycle are we in right now? On the multi-decade cycle?
Yeah, so the problem is that we are at the possibility, and see, this is us trying to study history and trying to predict the future. Dangerous game.
But I think Ray Dalio does this as well, right? He talks about this a lot.
Yes, you got it absolutely right. He's written an entire book on called Debt, right? Which is on this. So he studied the 1930s and 40s. That is the last time you had the 100-year cycle, which is the debt cycle. So that is when there was a lot of debt initially in European countries, and US took advantage of that. US also had a lot of debt, but probably the others had more debt, and they were able to finance a lot of the wars and be on the right side of that in the end. But the Great Depression was essentially an outcome of that debt cycle. Okay. That debt cycle is what we've been trying to toy around with for the last.
So I'm just confused. When a country is in debt, does it mean that we are borrowing money from the future citizens? Because who the hell are we borrowing money from? Because the country is a country, no?
Yes.
Money is there in the country. Like, who are we supposed to repay the money to? Like, when we say US debt, what is the US debt?
Yeah, I also don't agree with that argument. A lot of conspiracy theorists, I say, write about it that way, that you're borrowing from the future children have to pay for it. That's not how it has ever happened. Usually, a country does 2 things. One is it either defaults, okay, or it tries to inflate away the debt. These are the 2 outcomes that have happened in the 100-year cycle.
No, how does the debt even start in the first place? Overspending compared to what you're producing.
Yes.
So then I'm overspending, I'm printing more money, and in my books I'm writing that this is a debt.
Yeah.
Because I've printed more money than what I've made.
Yes.
So this is how it starts.
Yeah.
Then, but that creates an imbalance because I have consumed more resources than I made.
Yes. And you're not able to grow faster. So your GDP growth has to be at a rate such that you can continue to finance the debt. Moment you're not able to grow, then you're in a debt trap.
Okay.
Now your question is, how do I get out of a debt trap?
No, like what is the implications of it? Like, let's say I'm a country.
Yeah.
Let's say me and you are a part of a country. We have 100 rupees in front of us. But we decide to spend 150 rupees this year. And we write in our books that there is a 50 rupees debt. What is the problem? Like both of us are running the country.
Yeah. So it's down to what is the interest on the debt. So I spent 150, I got 50 rupees of debt, right? But I have 100 rupees GDP. So my debt to GDP would be 50 by 100, that's 50%. And my cost of that debt is on 50 rupees. If I have an interest rate of 5%, it's very small. Out of that 100 rupees.
No, but
GDP,
who is setting that interest? Both of us are only setting the interest. We are only running the country.
Yes.
So I will set 1% interest rate.
Yeah. That's what you will try to do always. That's why that's what the US is trying to do right now. Let's bring the interest rate to a level that my 125% debt to GDP doesn't matter.
Correct.
That's what you will attempt to do.
Correct.
But the bond holders may or may not let you do it. So that's the struggle. And who are the bond holders today? Who owns US debt? Everybody from China, India, Russia.
How did they end up owning US debt?
Because as consumers of, as US consumes from most of us and we are actually exporting to them, we end up taking dollars. How do we hold these dollars? We don't hold them in dollars. We don't just keep dollars in the Reserve Bank of India. We buy US treasuries.
Because US made everybody transact in US dollars.
Yes.
And when I'm selling stuff, I got US dollars. Now I'm like, what do I do with these dollars?
Exactly.
So might as well hold the
They're
US
doing
bond.
exactly what you told that I should do with my portfolio. They're doing it. The
So
Reserve Bank of India is doing it.
Might as well hold the US bonds. Now, if I'm thinking of lowering the interest rate, what can China do about this? What can they do? I'm the one manufacturing the bonds.
Yeah.
What can China do to stop me from lowering the interest rate?
China can sell the bonds and say, I don't think it's worth it.
Who's going to buy these bonds?
There's a publicly traded treasury market. It's very liquid.
Oh, very liquid.
Yeah.
And if
China has already reduced its bond holding from almost 1.2 or 1.3 trillion to around 700 billion over the last decade.
So if they sell the bonds, you're saying the dollar becomes weak.
Yes.
And the US can't have that happen.
Yes.
So if the demand for the dollar goes down, what happens to the debt situation for US?
Then it's impossible to finance.
Why? How does that work?
So we have 125 debt to GDP, 125%, which has to be financed and is being financed by various, not just the domestic economy, but by people around the world. Right now, say if the rest of the world says, no, we don't want to finance your debt, then they have to finance it domestically. Okay. And US, can you finance it domestically? So you'll have to sell it to the public. See, it's easier to give it to a reserve bank that will just buy your bonds blindly. Or it's easier to do it through the banking system, like what we used to do in India, known as the SLR. Many of the global banks or global, a lot of the countries, the advanced countries did away with that. But there is some chatter about it coming back. Because when you try to sell it to the public directly, they will look at the rate of inflation and say, hey, inflation is almost 10%. I'm not going to buy your bond unless it's more than 10%. You'll not be able to finance at that rate. Okay. But the reserve banks do it. Okay, so it's hard. It's much easier to do that. Or if you have an SLR, for those who don't know what's SLR, it's a statutory lending ratio. That a bank has to actually invest in government bonds. So in India, we had SLR fixed at at a certain percentage. All banks had to invest a certain percentage of their bonds in government till I think somewhere in the early 2000s. Then they made it a little easier. They said that, okay, you don't need to invest all of it. You can become easy and hold some of the items as HTM, which is hold to maturity. And rest of it, you can, keep as direct bond investing. So your mark-to-market gains and losses don't have to be written off. So this is all technicality. But we have reduced SLR a lot in India, but it's still there. Globally, it's not there. It can come back. Then you force your banks that if you're running a bank, 10% of your assets have to be invested in the government bond. This is how we do our financing in India when you don't get public finance. So they'll have to do that because if you go to the public will say, "Yaar, itna inflation hai. We are not going to pay you this much." So they'll not be able to finance.
They'll tell the banks, which is also my money only.
Yeah.
The banks will...
But the bank has to listen because they have a gun on the head.
So coming back to the US, you're saying that finally at the end of it, your prediction is that the US will start strengthening now. The US dollar will start strengthening.
That's the risk we start with. See, the stock market is not about knowing exactly it's going to happen. It's about developing a case and having a probability. Today, I see it as a probable outcome.
Well, how much probability would you put on it, a number?
Let's say 35%.
That's it?
Yeah.
Based on that, you've taken a bet?
Yeah, because I'll tell you, in my mind, it can easily go to 70-80%. Today, it still has to confirm. So, see, we look at, when I say that I look at Elliott wave analysis, I'm also looking at sentiment. So, what do I study? How do I say that the dollar is going to go up? I look at, first of all, its structure, which is the wave structure. Then I look at, okay, if it's fallen so much, what is the sentiment? Are people excessively bearish? So, that's the positioning, which I said that everybody is short. That's the first step.
So, what is the sentiment according to you right now among an average Indian investor?
I think they are still very, very bullish.
Right?
Yeah. At the investor level.
Correct.
They're very, very bullish. Which shows up in your data. Like if you look at the domestic flows, they're at the highest levels. The DII buying of the last 2 years is the highest of the last decades of data.
Correct.
So that shows a very, very optimistic scenario.
Right.
Now that, of course, doesn't necessarily mean that things have to turn badly. Because Indian investors starting to invest was a structural trend that started more than a decade ago.
Correct. So
now, a structural trend could continue. So I'm not saying that argument is wrong.
So my argument here is that you're saying that you have sold all your money from the Indian markets. The reason why you've done that is because you're expecting a correction so that you can get back in at a lower rate.
Yes.
But what if structurally the DII inflows will never let it happen? Primarily because of the rising income levels, rising number of demat accounts. There is so much of SIP book that's building up that the earnings growth, whatever has slowed down, will not matter compared to the liquidity that is coming into the Indian markets. Isn't that a structural reason why the markets will not correct as much as you think? So
far it has been an easy call. I'll tell you why. When we look at daily data, we look at DII, FI, right? We see that cash market mein DII bought 3,000 crores, FI sold 3,000 crores. It always seems to be matching, which means that they are very, very slowly making their sales because they didn't see a strong reason to do so. But in an environment where a global risk-off is happening and we say that, no, I have enough domestic flows, domestic investors will not get perturbed by this. It doesn't work that way because suddenly those sales will become greater than the amount you are able to absorb.
Okay, you're saying the FIs will eventually sell a lot.
They can.
Which
they're just not doing so.
To match.
Yeah, they can. Let me give you a statistic and it's not again, I say these are not played out, but this is data.
No, but if they can't even sell all at once, they have huge capitals because if they sell all at once, they will have impact losses. So they are trying to average out properly.
That's what they're doing right now because it's an easy trade, right? DIs are buying, let's just keep selling slowly.
Correct. DIs are buying, let me just match that so that I'm getting the price that I want.
Yes. But when prices start dropping is when you start accelerating your sales. Now, you may say, no, they will never drop, so they don't have to ever accelerate, which is fair. But below the surface, that's not true. A lot of stocks have already started to fall off a cliff. So when we study the macro, when we study markets at a sentimental level, we look at something known as, indicators that how many stocks are, say, below the 50-day moving average. How many stocks are below the 200-day moving average?
Is it a lot?
Yeah, it's more than 60%.
Okay. So you're saying that's a red sign.
Yeah.
Red signal.
60-70% of stocks are below the 200-day moving average. Nifty is near the all-time high. What does that mean?
So
it's below the surface sales.
If you were a foreign investor sitting in Dubai, right now having, let's say, 100 crores in India, you are thinking of taking all your money out because the currency is depreciating and you're finding better opportunity somewhere else.
Yeah.
That's how you are thinking.
Yeah.
Right? But at the same time, you are not investing in the equity market anywhere in the world. Like, I understand your argument that, okay, Indian market, earnings growth is happening, all of those ABCD reasons. So, but there are 200 countries in the world. So many stock markets are there. You're saying there's no other stock market in the world that you're interested in.
Because all the liquidity that has been created in the world, the largest amount of liquidity that is flowing out of US and Japan in a lot of currency creation that they have done because of their debt. That is the money that is going around in the world. It's like all countries are getting foreign portfolio flows at the same time. So there's a psychology. Now think of it. You are the fund manager. Like we are having this whole discussion without putting ourselves in the shoe of the fund manager. You're these 4-5 hedge funds. Okay, they're managing billions of dollars, and you're sitting in the US. If you get scared, are you going to say, let's just sell a little bit of India and buy a little bit of Brazil?
If I get scared?
Yeah, if you get scared that there's going to be a debt problem or there's going to be a dollar spike.
So
no,
that's what I want.
You would end up selling everything. That is how your psychology behaves. When fear comes in, you say, boss, I want my money back. You don't say, I'll move my money from here to there. As long as there's no fear.
You're saying I'll rather sit on cash.
Yeah, I'd rather bring that money home and put it somewhere. So I'd rather take my money back to the US and put it in US bonds, but I don't want to own Brazilian bonds now because the currency is going down.
No, I'm not talking about bonds. I'm talking about the markets, the identifying.
All the same, that when fear is there, you don't want your money in some other country. You don't know what's going to happen there. You don't understand the law.
But how long can you stay in fear? Like, because if I look at the last...
Usually the fear is that 1-2 year window only.
Last 1 year, everybody has been afraid only.
Yeah.
US AI bubble crash, Indian market is slowing down, tariff war, Trump is doing this. Everybody's been afraid only for the last 1 year, and gold and silver has doubled and tripled.
True.
So what do I do? If I'm afraid, I just sit on FDs.
Yeah, but then those are the 2-year windows in which you get the best buying opportunities. When those periods happen. You don't have to do this all the time. 90% of the time or 80% of the time markets go up. There's no doubt about it. And for that 80% of the time, the fear trade is actually useless.
So you're saying in the 30 years of your experience, that these 1 or 2 years is the time that you're going to be afraid and sit on cash.
Yeah.
You're that sure.
Yeah.
So
and if it proves wrong, I will get back in even in 2 months. That's why I said that I have to be an active portfolio manager. But these risks are real.
So right now, 100% government bonds, right?
Yes.
And what are you looking for in the next few months? How long?
But I'll tell you. So there's also the trading side to it. That what I can do, which may not be suitable to everybody, is that I can trade, right? So I can trade with say at a 20% level on the portfolio on the short side. So it's not that I have to completely sit out and do nothing and go on a holiday. There are going to be opportunities for me to be on the sell side of many things. Real estate stocks are crashing. I don't mind being short of real estate stocks.
But how will you go short on them? You will
futures, options.
So
I prefer options. People can choose futures, whatever way. But I'm saying that's the opportunity.
So what are you doing right now? 20% of your money. Are you doing some kind of F&O trading here?
Yes.
So what are you doing on this front?
So we do two types of strategies which I've suggested and I do. One is at a portfolio level. Now this is for even a lot of the listeners. They'll say like this is all not good stuff. I want to remain invested. And a lot of my subscribers on the research side also ask this question. They say, boss, I don't want to get out 100%. This is all okay. This is okay for you. We can't do it because I can't buy back if the market goes up. So what I've suggested, so this is a strategy now for everybody who's listening. 2026 December puts are available for around 420 rupees today. 25,000 strike. Usually only the December month is liquid. Other months are not liquid. Because FIs also participate in the December series. 2% is the cost of hedging your portfolio. If you buy equal value of your portfolio in Nifty puts. Just for 2%, you can hedge against this kind of an event.
2%.
Yes.
On the overall portfolio.
Yes. You don't have to sell your portfolio.
Okay.
But if you say your portfolio has a higher beta, which means that, if the market falls 10%, my portfolio will fall 30%, right? This is also happening with people.
Right.
I say, fine, then to that extent, buy a little more. So if your portfolio value is 1 crore, take the Nifty value of 1 crore and buy puts of that much. So it will amount to buying around 6 puts, right? 6.
But for December month, you're saying?
Yeah.
Why December specifically?
It's 1 year.
Okay.
So you get a 1 year time frame. You don't want to buy short period, right? We are taking a long-term topping call. We are not saying the market will fall for 2 months and go up. We are thinking in the next 1 year, there is a risk of a global risk off. If that happens, I spend 2% to hedge myself against that risk for the next 12 months.
So if I have 1 crore, 2 lakhs I will go to buy a 1 crore worth of put.
No, not, around 2 lakhs. Yeah, you're right.
2 lakhs to buy a 1 crore worth of put.
Yes.
Now, you said that if my beta is higher of my portfolio,
Increase that a little bit.
Increase what a bit?
The exposure. So instead of 1 crore exposure, take 1.5 crore exposure.
Okay, so tell me the scenarios. If the market goes down by, let's say, what you predict, let's say
let's say minimum case 20%. Nobody expects India
20%
to ever fall more than 20%. Let's say 20%.
20% drawdown.
Yeah.
What happens to my money?
So that's around 5,000 points, right? So the Nifty currently 26,000 goes down to 21,000.
Right.
My 25,000 puts will go up to 4,000 from 400. That's 10x.
Okay.
Right? So 420 will become 4,000.
Okay. Why does it become 10x?
Because I bought 25,000 December puts for 420 rupees. Market fell 20%. That 5,000 points, 21,000.
Okay.
So 25,000 put at 21,000 will be worth 4,000.
Correct.
So 420 became 4,000. So that's close to 10x. Okay. So I'm saying if it becomes 10x, which means my 2% cost of hedging will become 20% return.
Interesting.
Okay.
You've done those?
Yeah. To all the portfolio investors, I'm saying that. See, I'm saying I've gone cash. But a lot of my clients saying, I don't want to go cash. I say, fine, hedge. This is the simplest thing you can go. You don't have to go cash.
Just that I need to be willing to pay 2% of my portfolio.
You just pay 2% and hedge yourself against this wild risk. May happen, may not happen.
And if the market goes up by 50%, then what happens?
Then the 2% is a very small cost to pay. Your portfolio will go up 50%. Do you mind 2%?
No. So that's the game. That's how you play. Any other strategies that you would like to recommend to
So now this is a simple one for investors. Now when we trade, I try to do some kind of spreads. Okay, so spreads means you can buy some calls, you can buy some puts, but you have to time it.
Oh wait, sorry. The last scenario is that if the market goes nowhere, then if it's a flat market, then though I have lost 2% of my portfolio.
Then you've lost 2%.
So how likely is that then? That is also likely, sideways market or not?
Sure, it is.
Or let's say forget sideways, it has gone 5% up in the next 1 year, which is a possibility. Yeah. Then what happens?
You net 3%.
That's it. No?
That's it.
But I could have made 5%.
Yeah.
My loss is that I've given up 2% of my returns.
Yes.
Trying for the market to go down, hoping that the market will go down also. Okay, so fine. That is the first strategy. Second strategy?
The second one is essentially for traders. So people who are, what do you do in this type of market? Right? Market is up or down or it is sideways. There are 2-3 things you can do. Okay. Before going to the trading, I'll take the one next step people can do. This is for people who can, for the passive guy. He says, okay, I have some portfolio and I have some large caps. I have Reliance, I have Tata Steel, so on.
Because a lot of people don't want to sell because of the tax implication.
Tax implication also. That's also correct. Yeah. So then you can do something known as covered calls.
Okay, how does that work?
So covered calls is that if I have Reliance Industries, okay, I can sell calls of Reliance Industries. If I have Tata Steel, I can sell calls of Tata Steel.
Okay.
So if I sell at the money or slightly out of the money options every month, at the beginning of the month, you do it in the first week of the month.
But why am I selling calls instead of buying puts?
You're not betting that it will go down. You're saying that, I want to hold on to this portfolio. Okay. And I want a yield on it. This is a yield generation. I am saying market, you said market will go sideways. Okay. Sideways bhi jayega, so I will get the premium, na? So I will earn that 2% premium every month.
Converting my stock into an FD.
Into a FD.
Interesting. So basically, I will sell a call.
Against
let's say I own, right now ITC has taken a big beating, 20% drop. And I'm like, I know it's going to recover. So I don't want to sell it.
Correct.
So I'm like, I will sell a call of ITC. And then what happens?
Yeah. So maybe in a beaten down stock, you may want to wait for it to bounce a bit before you do that.
Okay.
But for any stock which is in between, it's bounced back 4-5% from a fall. You sell call options at the beginning of the month.
Why beginning of the month?
Because that's when the premiums are high. So at the beginning of each month, you have to do this covered call strategy, which means within the first 10 days
of the expiring monthly calls.
Yeah.
Okay.
Yeah. So in the beginning of in the first 10 days of the month, you sell the call option of the end of the month.
Okay.
And stock options are monthly only. There's no weekly, so there's no tension of that.
Right.
So you sell the monthly, and you'll typically get around 2% of the value of your of the option as yield.
Okay.
The margin also gets reduced. Why? Because you have underlying stock. So you can give stock as margin. A lot of brokers will tell you how you can do that.
Okay.
Earlier you could do it directly. Some of them do it through MTF. But essentially, when you give your stock as margin, you don't have to pay margin to the exchange.
Okay.
So margin also.
Okay.
And you are getting the yield on it.
You don't have to keep some cash in the trading account.
Yeah.
Because you're giving a stock
You're
as
giving
the
a
margin.
stock, yeah.
But I think 20%, 10% you have to keep some cash.
So there is a play around. Depending on the broker you're with, they sort of allow you to do something and take care of it.
Okay, fine. So then after that, what happens? It's a way for you to earn 2% on that.
On that every month by just selling the options.
This
So
is-
even if it falls, say for example, your stock, it's a large cap, falls by 10%, and every month you kept selling options, you would have earned back that 10% over time. So it's a different form of hedging, but
So how does this work? Like if I've sold a call,
yeah,
my maximum downside is the 2% of the premium amount.
yes,
Right? The premium amount is the maximum
loss that you'll make.
No. I think that's wrong. No, if I'm selling, I collect.
So
the premium.
you're collecting premium.
So then my maximum loss is unlimited, no?
Well, yeah, if the stock falls, your loss is unlimited.
Unlimited.
But you earn only that 2%.
Correct.
If the stock goes sideways, you still earn 2%. If the stock goes up, then yes, you give up some of your upside because the premium will go up in value to the extent the stock is also going up in value. But the bet here is that you're either going to be a sideways or a down market.
Okay.
And so therefore you will keep selling call options for the next 12 months because this market is going nowhere. So if anybody thinks that, okay, the market won't go down, but it will go nowhere because earnings are not growing, but yes, there is liquidity flow coming in. And so let's not bet on downside. Start selling call options on your portfolio every month.
Hoping that the market is going sideways. The only way I make money is if the market is going sideways, no? On a monthly basis.
Falls or sideways either way, because see, if it falls, you may immediately make a loss. But if you keep selling options every month, you'll keep recovering that. So
Okay. You're saying that I'll make a loss only when the time it corrects.
yeah.
But when the time it's going sideways, I keep collecting the premiums.
Yes.
So that way it's a way for me to do what exactly? Because at the end of the day, I will average out only. No, I'll make zero only.
No, you've earned the premiums. They've come to you.
Okay.
That 1.5-2% per month is a return you're getting.
Okay.
So even if, let's say, if it's even 1.5 into 12, you've made a good 20%.
No, but if the market corrects, if that underlying stock corrects by 20%, then I've made nothing.
Then you're even. At least you didn't lose anything.
Okay, otherwise I'd have been 20%
Down.
absolute.
Yes.
At least these collecting of these premiums help me hedge my risk.
Yes.
So this is a way for me to slowly hedge my portfolio by slowly earning something. And even if some correction happens, I'm like, okay, I made money.
Exactly.
Okay, so it's the second level.
Yeah. So this is called covered call. In a derivative language, we say covered call strategy.
Okay.
So we've done hedging, pure hedging, which is December options. Then we've done covered calls. The last one is for people who are active traders. Now, if you're an active trader, of course, you need to do some amount of timing, which means that if the market bounces, you have to time the top, you have to time the bottom. For that, you need to use certain tools and indicators. So we try to provide those indicators on our Strike Money, platform. But once you learn how to time highs and lows, then you can actually buy calls and puts and make money directionally.
But is it possible to time the market like that?
Yeah, it is.
But people say you can never time the market. Warren Buffett only says don't try timing the market.
He's an investor, not a trader.
So you're telling me that it is possible to time the market?
Absolutely.
But
when I'm taking this call that the market will fall, I'm also timing the market. We'll only know later on.
But how right have you been in terms of timing the market in the last 30 years? What do you think?
If I have to put a percentage on myself,
win rate, yeah,
I would say more than 70%.
70% of the time you say you've been right.
Yeah.
You're that accurate.
Yes.
And then why do people in the newspaper say, don't try to time the market, invest in mutual funds?
Because they are running a mutual fund.
That's the reason.
And there's another reason. So see, I also train people, right? So if I train people to do this timing, does it mean that all of them are able to do it? The answer is again no.
So in a way, it's not just about the theory.
Exactly. It's not about the theory. So there's one more science or logic, and there's an entire subject. It's called behavioral finance.
So you're a behavioral scientist expert.
No, I'm not an expert. But behavioral finance means that it's not that you have to be an expert. It's that you have to overcome your personal behavioral traits to be successful. So I can know the science of markets, which is technical, fundamental, derivative, whatever. Okay. I'll teach you my entire knowledge that I have, 100%. You will still fail. Why? Because your mind is not yet ready.
So tell me, what are the things that my mind is doing to me, which will make me fail in the markets?
So they're very, very simple things. We start fighting our ego, right? We have an ego that we want to be. So a lot of people come to the market. I have to be right 100% of the time.
Okay. That is impossible.
That's impossible. So when you want to be right 100% of the time, what it forces you to do, not book a loss.
Hmm.
Even investors do it. So the guys who are on the investment side, when they say don't time the market, they're essentially targeting the individual who buys a stock at 100 and moment it goes to 90, he can't sell. So he says, yeah, loss ho gaya, now I can't sell it, yeah, it will recover. And then the moment it goes back to 100, he sells it and then it goes to 120, right? This is a very well-known example.
Yeah.
How do you overcome this?
Yeah, how do you overcome this?
You have to overcome it.
How?
So it is mental training. It's just training your mind. So it's training your mind that you don't have to get out just because it bounced. You have to be able to read these data points. Now, we do it using charts, technical analysis, and what I call as sentiment indicators. Sentiment indicators are used to time the market. Why we call them sentiment is we try to measure whether all stocks are going up right now, all stocks are going down right now, and how are the participants' position? Are they completely long of something or completely short of something? This tells us that yes, sentiment has gone too far. And based on that, I try to do my timing. Now, once I can do that timing, okay, then I need to be able to execute. This is where the behavioral finance is. That it has reached here, let me sell. Now, what works against me? When markets are up, the news is always good. You have the best news in front of you. You can't execute because the sentiment is telling you go short. News is telling you go long. Trade deal ho gaya. How can you short this market? How can you sell?
Yeah.
It's the impossible trinity, right? You just can't do it.
Yeah.
How do you overcome? You have to train yourself to believe in your tools and indicators. So this training is not a one-day affair. Similar thing that if you're following somebody else, say you start following me, Rohit, whatever you say, I will do. So I say, okay, I'm right 70% of the time. However, moment you start doing everything I say, the first 4 times I go wrong, what are you going to say to me? You say, Rohit, you're a complete idiot. You just claim big things, okay, but you're nothing. This is generally what happens when we start a service also. We start a service, if your first 4 trades are running, everybody wants to unsubscribe. Or if it's a mutual fund or a PMS, people want to remove their money.
Correct.
But that might exactly be the time where you should invest. When there is a drawdown. If your PMS drops by 20% and your PMS manager told you that my maximum drawdown is 20%, that's probably the bottom from where he's going to do better. But people panic and they want to get out. So similarly, if my strike rate is 70%, 70% is a probability that my methodology works 70% of the time. Does that mean that is evenly spread? It's not going to be right, wrong, right, wrong. It's not going to work like that. It could be right, wrong, right, wrong, right. It'll still be 70%. So if I give you 4 wrongs in a row, the moment you start following me, you're going to say, I'm an idiot. You'll never achieve 70%. So then what a lot of people do, who follow other people, they go to broker 1, they say, okay, iska research follow karta hu. Then the moment that goes wrong, they go to the next one. That goes wrong, they go to the next one. Now, if I say this guy is 70% right, this guy is 70% right, this guy is 70% right, but you are picking and choosing, so you're spinning a coin, probability of 0.5 into 0.7 is 0.35. The experience of most people who are picking other people is 35%. They say everybody is an idiot. So there's so much psychology in this that just being able to follow somebody who you think is right is also so difficult.
Right.
And so that's again behavior.
Interesting. So finally, you were saying something about the trader. What can a trader do right now to time the market?
So yeah, you have to believe that you can time. You need to use the right tools. I mentioned sentiment indicators, charts to be able to time.
So
if you are in that camp, then you start trading either futures or options. I prefer options for a reason. Okay, futures can give you sleepless nights. Like if you were short and the trade deal was announced tomorrow, the market opens 1200 points up. Your account is cleaned. And that's a reason why I suggest that you do not trade in the futures market.
Okay.
Now SEBI comes out and says that all option traders lose money and retail investors should not get in. I agree.
Yeah.
That's true. But it's because they have not encouraged themselves to learn, one, the science of trading, and then, of course, the behavioral finance problem. They'll have to get over that to be able to succeed on the trading side. But coming back, if you can do the timing, there are ways you can protect yourself. I'll give you an example because this is a strategy we executed last week. On budget day when the market was falling, I said, it looks like the market's going to fall. Okay. But don't just buy puts. buy a spread, buy 3 times the puts and 1 time the call. Okay. So 25,000 puts and 25,500 calls is what I didn't suggest the exact strikes, is what I'll tell you I executed. Okay. What would have happened? That
3
day
times the put, 1 time the call.
Yeah, 1
so
time.
If I have 10 lakh rupees,
Yeah.
you put
7 lakhs into the puts and 3 lakhs into the calls.
Okay. 7.5 and
Yeah,
then
yeah.
2.5, no?
Yeah.
7.5 lakhs in the puts and 2.5 lakh in the call.
Yeah.
This is like a multi-legged
Yeah.
strategy. Then?
Now the market fell on budget day. So initially it looked like, okay, that's good. My puts will make more money than the calls. I'm losing. I hold on to that strategy.
Wait, just to wrap my head around this. So the puts will make, you're buying all of these things, not selling.
Yeah.
You're buying all of them.
No
You
selling.
bought the puts.
No selling, no naked.
Three puts you bought. And if you bought them, you had to have a lot of capital also to buy this. Correct?
I mean, you can buy 3 puts. It's not a lot of capital.
Okay.
It depends on how much size you want to do. My size may be different.
You just have to pay the premium for it, right?
Yes.
So give me an example of how much premium you had to pay for 3 puts.
So let's see now, what you said, 10 lakhs. I put 7 lakhs in the puts and I put 3 lakhs in the calls.
Okay.
The price of the puts at that time, approximately 250 rupees and the calls was 160 rupees.
Okay.
So I put that much money and I buy that quantity.
250 into 3 and then 150. Yeah. Right? 750 rupees for the puts and 150 rupees for the call.
Yes.
And then you had to also give the margin to...
No margin. I'm buying options. There's no margin.
You just have to pay the premium.
Just have to pay the premium. Market falls, on budget day, and I feel that, I'm right. Next day trade deal happened. I would have lost a lot of money if I was in the futures. I would have lost a lot of money if I had only bought puts.
Okay.
But I suggested you buy both. So I calculated that if I only buy puts, next day if I had held on to it before the trade deal, I would have lost 70% of the premium in the morning.
Okay.
250 had become around 70 rupees.
Okay.
But by buying both, because the calls went up, because market went up a lot, so even the calls, even though they were 1/3 in quantity.
1/4 in quantity.
1/3. 1:3, I said.
Okay.
7 lakhs, 3 lakhs. So 1/3.
Okay.
The profit that you made on the calls because of the big jump made up for most of the loss. The loss was only 10% on the premium.
Okay.
So I'm not even giving an example ki maine paisa kamaya. I'm giving you an example that how options, if properly used, even in an outsized event, will not lose you too much money. But if the market had crashed after budget day, you would have still made money on the puts. Now, this is one type of strategy. There are many other different types of strategies that you can learn and incorporate.
So this is what you would suggest for people to do in this year?
In this type of market where there is a lot of volatility, having hedged trades or doing spreads. Now, there are people who do like buy call and then sell an out of the money call as well. That's a different type of trade. But in that, what you do is you actually limit your upside. I usually prefer not to limit my upside. So I try to keep the positions open. And therefore, I do. This is some kind of what you call as a type of strangle or a type of straddle, slightly out of the money straddle or strangle. Whereas, and with a spread, with a directional bias. So typically, a strangle in the textbook is equal call and put. I have said, let me have a directional bias. Okay. Then there are bull call spreads where you buy a call option if you think the market is going to bounce back, and then you sell calls also out of the money. So that reduces your cost of thing. But if you do a spread, then you're also locking in if it goes up more than that amount, you will not make money. You will only make money between the call that you bought and the call that you sold. So depending on your return expectations from the market, you can come up with a strategy that is suitable to you. The one that I gave is a high return hedge kind of strategy that you can actually use. But it requires good timing because you want to be on the right side at the right time. And so that if it goes in your favor, you make a good amount of money.
Perfect. So how do I like learn more about this from you? You also run this company called IndiaCharts.
Yeah.
So what are the things that you offer for me to like get started on all of these things?
So we do things at 3 levels. One is research. So we are SEBI-registered research analysts. So we offer research if people just want recommendations and want to read reports like all this detailed stuff, macro. I write a monthly long short report, which is monthly or bi-monthly, which explains all of this in detail with charts. Now, if somebody wants to learn how to do it themselves, learn Elliott wave analysis, learn long-term cycles, how to execute, how to enter, how to exit, how to put a stop loss, then we do an entire mentorship program, which goes on for 3 months plus every Sunday, 3 hours. You have to dedicate that kind of time.
For 3 months?
Yeah. And
Every Sunday.
Every Sunday. And actually goes beyond 3 months. So till I don't finish, I don't finish. We've already done 3 months this time. We're going on for the 4th month. So we finish like 3 levels, and then they can repeat this session forever, for life, every year when we do it.
You only teach Elliott wave in this?
No, this entire thing, which is we teach technical analysis, we teach Elliott waves, and then we teach how to combine it with fundamentals of a company and do long-term investing. How to use it to understand long-term economic cycles, the bond market, the inflation, and then take decisions on sectors. And then how to execute entry-exit, which means people want to know when to buy, when to sell. So using a combination of tools and indicators, like long-term investors also face this problem that I bought a good stock, it's up 3x. How do I hold on? Should I get out? So can we use certain technical setups to help us hold on the entire cycle and not get out early? So we try to solve these problems using different models and help them to get a solution, to how to do that. So it's meant for people at all degrees, whether you're an investor, trader, you can use these methodologies in any time frame. And how to do that is what then we do in the final level. Once they've learned the basics, then I can go into these advanced topics, including this options trading part, which we spoke of. Since I've been trading options only long side for this, I think since 2001, since it was launched. I have never sold options.
Okay.
Because the big money is in buying options.
Right.
But it requires timing, and timing not everybody can do. So I know that it's not everybody's cup of tea.
But you're one of those few people who can do it.
I can do it, and again, the people I teach don't always achieve it because behavioral finance problem. So it's a circular thing, but yeah, if you want to, you need to get your knowledge. So this is the second part. And then what followed that is when we thought a lot of the sentiment indicators and tools that I was using was not there on any platform. We had to teach it to them or give it to them on some other platform. So we said, let's create a platform on which you can have all tools and indicators, plus many of the things that generally people look at for doing research online, and put it all in one place. So we created Strike Money, which is a singular terminal. And people can use that terminal to get fundamental data with charts of the fundamental valuations, historical charts with price. So you can see it all together on one screen. You can look at the sentiment indicators. You can use our proprietary technical indicators for timing, when to buy, when to sell, all of that, the various tools. So that's 3 levels. Like one is you need the tools, one is you need to learn how to do it. And if you don't want to do all of that, you just read research and, whatever people like. So we've created all 3 ends.
And I think, Rohit, my biggest takeaway is that it's not easy. It's tough to do what you do. And I think there's a reason why 93% of them lose money, because they're not even doing 1% of what you're doing. But on that note, Rohit, I think let's wrap up the conversation. I think that's the extreme of my understanding of what this entire space is. Lots more for me to learn as well. And would love to call you once again, once I'm more evolved in terms of understanding these things.
Sure.
Any last thing that you would like to share the audience with?
No, surely. Thanks a lot. I think I was really happy in sharing a lot of these details and knowledge. And the main point is there are two things I'll say. One is, of course, educate yourself. Educating yourself and doing it yourself is how you make big money. When you hand it over to someone else, of course, you're creating a savings profile for yourself for the long term. So I'm not saying that's wrong. You will end up saving money and you'll create a corpus. But if you're trying to create great wealth, it has to be done yourself by taking responsibility for your money. And so educate yourself and get there. And one last thing, which is important to trading and investing, and is often less spoken about, that it's very important sometimes to take money off the table. In trading, it's actually required very, very often. Every time you make some money, we get carried away with our gains, and then eventually the gains become losses. You have to keep taking money off the table. So one of the things that I do regularly with my trades is that when trades make money, I invest it, for the long term, so that it doesn't go away. Or I use it for something critical, like maybe buying a house or buying the car that I wanted to. Don't let that money go back and rotate in the market, because you might have a losing streak tomorrow.
Yeah.
And that and you may not have done what you really wanted to do in life.
Right.
So these are the takeaways for everybody.
Makes a lot of sense. Thank you so much, Rohit. I think lots to learn for anybody who has watched it for this long. I think it's an eye-opener for them also, that they are all just beginning their journey. Thank you so much, guys. If you've been watching until so long, please let me know if there's any questions that you feel like I missed out on asking in the comment section below. On that note, I'll see you guys on the next one.
Before you go, guys, if this episode
gave you even one insight that made you think differently about money, don't just keep it to yourself. Share it with your friend or family member who could use it too. And if it sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make these conversations sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with at least one new thing every Wednesday.